Aloha, welcome to Chapter 10. And in Chapter 10, the topic is liabilities. Liabilities, if you recall from the very beginning, one of our first lessons, we talked about the accounting equation. A liability, simply stated, is an amount owed by the business to creditors. I think it's important to note, and I think have a basic understanding of how liabilities fit into the equation in terms of being a source of financing for the business. I think I like to present it this way. The first source of resources for the business should be from its revenues, and I think more specifically from revenues less related expenses. So if you think about the income statement, revenues minus expenses provide the business with net income. For any business, that should be the first source of resources to run the business. If revenues and net income are insufficient to cover all of the obligations of the business, then the business has two other areas that it can look to as sources of resources. One of those areas, which is the topic of Chapter 10, is liabilities. The business can purchase goods and services on credit or take out loans, take out short-term loans, take out long-term loans. Or if the business is averse to extensive debt, then the business can look to the equity section of the accounting equation for additional resources. And when we look to the equity section of the equation, our primary focus then becomes ownership, and so the business can go out to the owners for additional funding or resources. So again, a business basically, and this applies really to any organization, you look to your revenues as your first source of resources to run the business. That being perhaps insufficient, you would look to either liabilities, taking on debt, borrowing money, or equity, getting additional monies from existing owners, or possibly bringing in new owners with capital investment that would provide either of these two categories in the accounting equation, would provide the business with additional resources to carry out its plans. So again, to summarize, what types of transactions create liabilities? First type would be the business buying goods and or services on credit. These types of liabilities would generally be current liabilities. Secondly, the business from time to time may have a need to obtain short-term loans to cover cash flow needs. And again, if they are short-term, that means they would be classified as current liabilities. We'll talk about current versus non-current shortly. And then finally, the business can also issue long-term debt for expansion. The three main types of transactions that would result in the creation of a liability. Now, talking in terms of classification of liabilities, a liability may be classified as current. That is, that amount owed is due within 1 year. A liability may be classified as non-current or long-term, which means that the amount is owed in periods that exceed 1 year. And finally, a classification that you see more often on the balance sheets of larger organizations, although this classification of liability can really appear on any organization's balance sheet, and that is a contingent liability or a potential liability. A book explanation of a contingent liability would be a liability that arises from a past event, but final disposition of that potential liability depends on some future event. And probably the best example of a contingent liability is a lawsuit. A lawsuit generally occurs after some event has happened. Something has happened in the past, and so there's a lawsuit. Let's say the company is being sued for several $1,000,000, and so it's a contingent liability at that point in time, and final disposition of that liability would depend on the outcome of the lawsuit, which would be the future event. I think this is a good lead-in for Chapter 10, short lesson, and so we'll spend some time in subsequent lessons covering one or two of the exercises in this chapter. Thanks for your attention. I hope this has been helpful. Thank you.